Hello everyone. In the last video, we looked at the basics of derivatives. In today's video, we will look at some important concepts in derivative markets for common investors. If you're new to this, going through the prior introduction to derivatives is highly recommended. First, let's look at liquidity price discovery. In order to get the best market price for an asset, it is essential that there are enough buyers and sellers of the asset so that the price is discoverable or fair and is not affected by the supply-demand imbalances. Derivatives allow more ways for transactions to happen on underlying assets, which means that they effectively help to increase the number of buyers and sellers of the asset. This then leads to more transactions, making the underlying asset more liquid. As more transactions happen, the supply and demand of the asset will move closer and closer to the equilibrium or fair price, thus improving price discovery. Regulations. Financial markets are a key contributor to a country's stability and economic growth. Consequently, they are heavily policed by regulators to prevent any mischief or wrongdoing. Since derivatives add more layers of complexity to the underlying asset, different market regulators limit the use of these instruments in their markets in line with the sophistication or savviness of the market players. As a general thumb rule, regulators in emerging markets are typically more restrictive as compared to their developed markets counterparts, meaning that the scope and volume of derivatives transacted in emerging markets is also typically lesser. In such markets, this reduces divergence in the understanding of most market players to avoid economic mishaps. Counterparty risk. When engaging in a derivative transaction, you will be facing a counterparty. In exchange-traded derivatives, the exchange acts as a middleman to eliminate the risk of any counterparty defaulting on the transaction settlement. There are also over-the-counter derivatives which are bilaterally traded. It is generally preferable to trade in exchange-traded contracts like futures, which are cleared via an exchange, vis-a-vis swaps, which are settled bilaterally to avoid exposure to this risk. The flip side is that the choice of derivatives available to trade via exchanges may be limited. Underlying and margin. One need not actually buy or sell the underlying. Thus, one can increase exposure using derivatives without increasing capital by trading on margin. Also, since the underlying is not physically purchased, one can even transact logistically cumbersome assets like real estate, oil, or gold. Volatility. The one factor affecting derivative markets that is hardest to gauge would be volatility. Fundamentally, what it means is that derivatives tend to be more costly when the markets are more chaotic, i.e. volatile, while they are relatively cheaper when the markets are more stable. Now, derivatives can potentially be misused, and following points should be kept in mind by investors. First, the complexity in derivatives causes potential mis-selling or misrepresentation to gullible market participants. Technical understanding of derivative payoffs, their underlying, and some of the other factors we saw earlier, like regulations and counterparty risk, is difficult to understand. Since derivatives can be traded on margin, there could be supernormal gains or losses which could get addictive like gambling. Let us now look at some real-world applications of derivatives. Derivatives are commonly used in financial risk management. They can help you guard against financial risks. Let's look at what these risks could be. Say you run a business where you receive orders that need 1 month to fulfill and the selling price of your product is 80 rupees. If a dollar is worth 80 rupees today and the buyer wants to pay in dollars, you will sign a contract today for $1 to be paid upon delivery. Now, if the dollar-rupee exchange rate after a month is in fact 75, effectively you have lost 5 rupees, 80 minus 75, on account of the exposure you have to the US dollar. This causes risk. To protect against this, you can purchase a derivative contract called a forward that will allow you to fix the amount of rupees you get paid after 1 month when you sell $1. This forward price is a definite price that you will get for your contract and is known on day one. So the movement in the exchange rate will no longer affect you. Let us take another example. Say you have idle cash at home or lying in a bank account earning some interest. In the real world, we have inflation. So the value of your money is expected to erode over time. To protect this value, it must earn a return that beats inflation. Derivatives may be used to increase the return in the following two ways. Number one, systematic arbitrage. Let's first understand arbitrage with a simple example. Suppose a 10-liter water dispenser refill costs 100 rupees, while a 1-liter bottle costs 20 rupees, and the price of an empty bottle is 5 rupees. You can theoretically fill 10 such bottles of water by spending 100 rupees for the large dispenser and 50 rupees for buying 10 empty bottles, for a total of 150 rupees. Then you can sell these 10 bottles for 20 rupees each, making a total of 200 rupees. So for every 10 bottles you sell, you can make 50 rupees. Similarly, in financial markets, you can have a case where the price of one stock is different in two exchanges. To illustrate, let's say a Tata Motors stock future sells for 1000 rupees in BSE but fetches 1002 rupees on the NSE. Given there is enough supply in the BSE and demand on the NSE, you can theoretically go long the future on the BSE and short the future on the NSE, thus pocketing 2 rupees for every such stock pair. Over time, more and more people will buy from the BSE, the price on BSE will rise, and as you sell more and more to the NSE, the price on NSE will fall, eventually settling at an equilibrium price of 1001 rupees, and the arbitrage disappears. Second, speculation. Speculation is not really different from betting. Instead of betting on horses or playing card games, here you bet on an outcome in financial markets. If this works out in your favor, you stand to make gains. If it goes against you, there is downside as well. Let's say that you want to bet that the stock price of a certain company will not go above 100 rupees in 1 month. It means you should then be willing to sell that stock for a price of 100 rupees at most. How do you do that? Using derivatives. Well, you would write a call option, a month to expiry, on the stock that allows the buyer to buy the stock from you at 100 rupees. Now, from the option buyer's perspective, he ensures that he never has to pay more than 100 rupees for that stock, and from your perspective, you earn a premium by selling him that option. You are betting that the price in the market never goes above 100. But if in reality the stock price touches say 101, then you will have to make good 1 rupee of difference to the option buyer when the option gets settled. In conclusion, derivatives offer different ways for risk seekers and risk hedgers alike to fine-tune the risk of their portfolio. This, of course, requires homework on the part of investors taking part in these transactions to reap the full benefits while staying aware of the potential pitfalls.